Regulatory Project Manager, TC Energy. Phil Roberts, Board Chair with the Calgary Chamber. Desiree Bonanno, Shirt Call and Board of Director. And Ross Glenn with RGO. A round of applause for our head table. So as many of you know, we are a not-for-profit commercial entity founded by business and funded by business. And so events like this and conversations are not possible for us without strong support from you, our business community. And I want to thank our sponsors and the members that are here today. First of all, I'd like to thank RGO for their ongoing support of Chamber events. And I also want to thank all of the business community for their continued investment in the Calgary Chamber. So for those of you that are here today as guests that may be experiencing the work of the Chamber for the first time, I encourage you for financial contribution for the Chamber because it is our privilege to represent your voice. We are very much stronger as one voice, one business community. And I also want to thank our purpose partner, Nutrien. Nutrien is a purpose partner for us, which means that they want to nourish, power, and inspire the Calgary business community, and we thank Nutrien for trusting us with that. A round of applause for RGO and Nutrien. So a little bit of housekeeping. So make sure your cell phones are on silent, and we want to encourage you to follow the conversation digitally. Our handle is @CalgaryChamber, and our hashtag is #PodiumOfRecord. And during the conversation today, I'm going to be accepting questions from yourselves. So there's cue cards on your tables, so feel free to write your questions as the remarks are being made, or maybe you've come with questions. We fully want strong engagement, and that means get your question answered. So that's what those cards are for. So a little bit of an introduction here. So since 1934, when the Banque du Canada was founded, it was really all about ruling legislation that had not changed since then. And what it is to regulate credit and currency in the best interests of the economic life of the nation. So for many Canadians, all that we know of the Banque du Canada is that they make some decisions and somehow that impacts the interest rate on my mortgage or what I owe the bank. So, however, the bank is responsible for much more than just managing the rate of inflation. The Banque of Canada holds an essential role in Canada's federal framework to promote the economic and financial welfare of Canada. This includes design, creation, and distribution of currency, the framework for which ensuring nations' financial systems, both domestically and internationally, and acting as the fiscal agent for the Government of Canada by managing its public debt programs and foreign exchange reserves. The Banque of Canada also regulates and regularly publishes reports on research papers about the state of the economy. One of these is a quarterly business outlook survey, with one was most recently published here in mid-April. The spring survey results reaffirmed that we have been feeling here in Alberta for some time, that we want to be positive, but we are being held back in our growth and uncertainty with the lack of investment capital being invested. The same report shows that sentiment across the country that we need to have investment capital flowing. Provinces outside of the prairies have a much healthier, optimistic investment outlook and growth plan, but as a province, we are ready to grow. We want to ensure and maintain the quality of life that Alberta is known for. But to do that, we need a framework that enables us and encourages that growth. That framework comes from a regulatory and tax certainty, both pillars that the Edmonton and the Calgary Chamber had strongly advocated in our provincial election. To grow, Alberta needs the commitment and support of all levels of government working together. For government to ensure that policy is always prioritized over politics. Because the results of the Alberta's economic recovery do benefit all Canadians. So that's why we're very pleased to welcome to Calgary Senior Deputy Governor Carolyn Wilkins As a member of the Bank of Canada Governing Council, Ms. Wilkins is part of the policy-making body of the Bank of Canada. One of the bank's main tools for implementing monetary policy is the target for the overnight rate, more commonly known as the benchmark interest rate. As we know, as much of that impacts, like I said, not just our mortgage rates, yesterday the bank had announced that the interest rate will be held stable at 1.75%. Now that decision was due to the economic data continuing to show what the bank's April monetary policy report had highlighted. Slower than expected economic growth as a result of shrinking investments and exports in the energy sector as a result of ongoing transportation constraints. Decreasing investment outside of the energy sector stemming from that ongoing trade tensions and uncertainty, and a global slowdown in economic activity. All of that factored into that rate. The bank still does expect growth to rebound due to the oil price recovery and the national housing market stabilizing. I know Ms. Wilkins is going to be giving us a comprehensive understanding of the process that goes into this rate decision and also overall how yesterday's decision came to be. So I'd like to now introduce Carolyn Wilkins, who was appointed to the Bank of Canada's Senior Deputy Governor in 2014 for a 7-year term. As Senior Deputy Governor, Ms. Wilkins oversees the strategic planning and economic and financial research of the bank and shares responsibility for decisions with respect to monetary policy and financial stability. She also oversees the bank's analysis of international economic developments in support of monetary policy decisions and serves as the bank's G7 and G20 deputy. Ms. Wilkins holds an honors bachelor's of Arts in Economics from Wilfrid Laurier University and a Master of Arts in Economics from the University of Western Ontario. She was named as a winner of Canada's Most Powerful Women Top 100 Award by the Women's Executive Network in 2016 and again in 2018. I now welcome you to the stage.
Well, thank you very much for that warm introduction, and I think the words that you said set the stage pretty well for what I want to talk about. It's a real pleasure to be here in Calgary to provide an update on the Canadian economy and to talk a little bit about what went into the decision that Governing Council took yesterday to leave our key interest rate unchanged. I'd also like to thank you for the invitation. So, there's certainly enough to talk about when it comes to the economic outlook. There's a trade war between the US and China. There are the ongoing challenges in doing business in oil and gas here at home, and the delivery constraints that are affecting a broad range of products. I think it's fair to say that Alberta and the energy-intensive regions have really been on an economic roller coaster for the past few years. And this has led to painful adjustments for many people, many of you in this room, but it's also weighed on Canada's bottom line. This is pretty important. Seen from a macro perspective, nonetheless, Canada's economic performance has been relatively solid. And that's the perspective that we as central bankers need to take to meet our inflation objectives. For much of the past couple of years, the Canadian economy has been operating near full capacity overall. And the unemployment rate has fallen to a 40-year low. And it's in this context that Governing Council raised the policy rate during that period to a more normal setting. Now, inflation is currently near 2%, and our core measures of inflation have been hovering around that level for a little while. Unfortunately, several developments at the end of 2018 and the beginning of 2019 have set us back. There was the drop in oil prices last autumn, and there are ongoing transportation constraints, as you well know. escalating trade tariff actions by the US and China and the related uncertainty that's around that has undermined trade and business investment. And housing, here at home, the linchpin of the recovery since the crisis, has slowed sharply. Now, we said in our April monetary policy report that all these developments would lead to a detour in the Canadian economy. We projected much softer growth in the first half of the year before picking up for the rest of 2019. We're not going to do a new forecast until our July monetary policy report, but the data that we have so far suggests that the April view is largely on track. Now, I'm going to talk about why we continue to expect a pickup in growth in Canada, and I'll highlight the main points of discussion among Governing Council members that led to yesterday's decision. First, though, I'd like to spend some time on the outlook for business investment because it's a critical piece of our forecast. Investment is really at the core of productive businesses, no matter what sector you're operating in or what region you're operating in. It's also the foundation of vibrant, sustainable economic growth. Our living standards depend on it. So how does business investment influence our standard of living? Well, investment makes workers more productive by increasing the capital they have at their disposal. You can clear your driveway a lot faster with a snowblower than you can with a shovel. I should know, I'm from Ottawa. But new investments also tend to harness the latest technology, and this further boosts productivity for both workers and for firms. The energy industry is using fiber optic monitoring to keep pipelines and other critical assets performing as well and as safely as they can. And this type of investment, we all know, when money's on the line, actually does involve some risk for business. But it can have major payoffs in terms of greater competitiveness. It can also have payoffs for Canadian workers. Higher productivity is what gives you the means to have growth in wages and in incomes. And the economy overall can grow faster without causing inflationary pressures to build. Of course, as a central banker, I'm going to bring it back to that. There's nothing like a few numbers, I think, to really illustrate a point. If you just take the last 15 years and you calculate, well, what was the average potential output growth for the Canadian economy? It was a little under 2%. Well, fully half of that is because of growth in the labor force, okay, that's out there, that's the ability to work. But steps by firms to increase their productivity through investment, economists call this capital deepening. Well, this was also vital to potential output growth. 0.6% of that 2% is from capital deepening. And up until 2014, when oil prices fell, about 1/3 of that capital deepening came from investment in Alberta. It's pretty important. So thanks to capital deepening overall, GDP in 2018 was 177 billion Canadian dollars higher than it would have been otherwise. It's not peanuts, that's $5,000 per Canadian, and it's a benefit that should continue every year. So investment is incredibly important to all of our bottom lines. But what goes into the decision to invest can vary across firms. Now, there's one or two common elements that we can build on, and the most obvious is the current economic context, both globally and in Canada, because it relates to future sales and whether or not financing costs are going to be attractive. And in this context, global economic prospects and the context for global economic prospects more generally, it's obviously heavily influenced by the two biggest economies in the world. The trade war that the US and China are waging right now is damaging not only their own prospects, but also those of the rest of the world. Now, we had been expecting that the global economy would slow from last year's pace. The US economy going into the first half and then into the second half of 2018 was growing at 4%, and that's way above what we think their non-inflationary speed limit is. And we knew that interest rate increases and the fading impact of the tax cuts would bring U.S. growth back down to a more sustainable pace. And some other central banks, including the Banque du Canada, were also taking steps to bring monetary policy settings to more normal levels. And China, they imposed some new financial regulations to slow their economy, but also to support financial stability there. The trade environment, however, has made the global slowdown worse than had been expected. It's undermined business sentiment, it's held back investment decisions of dozens of economies, including Canada's. And the slowdown in investment has weighed on global trade as well. Firms are just putting off the investments they need to do to increase their capacity to be able to export more. Now, our April forecast estimated that trade uncertainty, including the uncertainty around the ratification of the Canada-US-Mexico agreement, would cut the level of business investment in Canada by 2.5% by the end of our forecast. That's 2021. And of course, it would also cut the level of exports. Overall, our forecast said that the growth in Canada would grow from 1.8% last year to about 1.2% in 2019. And I want to be clear that slower growth isn't all about trade uncertainty and the global slowdown. This outlook that we have also takes into account the effect of lower oil prices and transportation constraints in energy-intensive regions. Just to give you an idea how important that is, growth excluding these energy-related factors would be 0.3 percentage points higher. The outlook also accounts for the housing slowdown, which has been deeper and more prolonged than we had expected, particularly in the Vancouver and Toronto areas. So I'm going to get a bit more to housing a bit later. So given these developments in both Canada and globally, it's no surprise that policymakers have responded. Since the beginning of 2019, the U.S. Federal Reserve and other central banks have signaled a slower path back to normal monetary policy settings. And China has announced stimulative fiscal and monetary policy measures. Global financial conditions have eased and market sentiment has improved as a result. And this has helped boost prices for oil and other commodities so far this year. It's also one of the reasons why in our April monetary policy report, we called for a firming in the global expansion later this year. The wild card, however, is the trade war. Well, how costly are trade wars for the global economy? Well, it depends what the trade war involves. In our April report, we said that the tariffs over the past 2 years and the trade uncertainty that we felt was there at the time would chop 0.4 percentage points off GDP by the end of our forecast. That's about $350 billion US dollars. And this is really only a rough estimate, and it's hard to know exactly how sentiment affects people's decisions. But what we do know is that it'll matter more for trade-dependent countries like Canada. So where does this economic context leave us in the outlook for Canadian business investment? Well, we expect it to expand gradually overall, led by firms that are outside the oil and gas sector. It should be the strongest in places where companies have confidence in future markets and the sales, and also they need to invest to expand capacity or to become more productive. Attractive financing costs like those we see today, as well as the recent incentives that have been put in place by the federal government and some provincial governments, are key ingredients. Now, according to businesses that responded to our spring business outlook survey, investment plans are still healthy in most regions, not all regions, as you said at the beginning. Now, this is particularly true in service industries, such as IT, where demand has been strong. Recent data that we've seen so far suggests that investment in the non-energy sectors has started off the year in positive territory. It's not really new, though, because digitally economic activities now make up about the same share of nominal GDP in Canada as do mining, oil, and gas combined. And the third largest digital economy in per capita terms is in Alberta. That's just from a new study by Statistics Canada. And the thing that's interesting about digitalization is it isn't just about the service sector. It's transforming the resource sector and goods sectors too. Just one example is data-driven farming in the prairies. Here, farmers are working to harness big data to find ways to economize on fuel and also to improve yields. The energy industry, you can read stories about this in many places, are using automation, AI, machine learning to cut costs, but also they're successful in cutting emissions. Now, it's possible that some kinds of investment like this are not showing up perfectly in the statistics, and that's because a lot of these types of investments are intangible in nature. And some of us have been around long enough to know that this idea of intangible investment isn't really new. It's been around for decades. Computer software started to be included in investment in the 1990s, which doesn't seem long ago to me, but it is. And even though they're not showing up in official statistics, some kinds of investment are becoming even more important to the global economy. There's technology to streamline business processes, or database development, or moving service to the cloud that may not be an investment, it's actually maybe in a business expense. When it comes to the energy sector, we expect the current adjustment to continue. Just think of where Alberta and other energy-intensive regions have been. If we go back to between 2014 and 2016, energy investment dropped by 50%. In April, given all the conversations we've been having with businesses in the region, we estimated that the investment in the sector would drop another 20% before stabilizing. I can't emphasize how important it is that we do talk to businesses, because that kind of result's not going to pop out of a model. So what our forecast says is that investment should average around $40 billion over the next 2 years. That's still 15% of total investment in Canada. It's still an important part of investment in Canada for sure. Now, as spending in oil and gas stabilizes, the growing investment that's happening in other sectors is going to show up more clearly in the headline numbers. I'd like to emphasize that we're being prudent in our outlook for investment. In fact, if you look at our forecast for investment as a share of GDP, it's pretty flat over the forecast horizon. I've been in the forecasting business long enough to know that one of the toughest things to figure out is when investment intentions will actually translate into investment decisions and in actual investment. And I also don't think that the trade war is the only reason for disappointing investment in Canada and globally. Even before the latest slowdown, a downbeat outlook about the strength of future demand led to weakness in global business investment in the years that followed the crisis. There's a couple of structural or underlying factors that I think are pretty important to understand. And the first is just demographics. Population aging is limiting the growth of the workforce in Canada and in many other economies. And this reduces the economy's potential growth rate, but it also puts a limit on the returns that any investment can expect. Now, the second issue is that the boost to world trade that came from investment, that came from China joining the World Trade Organization in 2001, well, that boost has run its course. And Governor Polat spoke about that in Iqaluit a few weeks ago. Now, these longer-term structural issues aside, Canada is trailing on a number of indicators that we know increase productivity and competitiveness. Among these indicators are things that you would expect: investment in information and communications technology, R&D. We are investing, but other countries have been investing even more than we have. And companies across the country tell us in our visits that a number of competitiveness issues are holding back decisions to upgrade or to expand capacity in Canada. These are wide-ranging. It depends on the industry, maybe it depends on the province, but they tend to focus around common things that relate to business costs, like electricity, the regulatory burden, and uncertainty about the approval of projects. And when I'm talking to business leaders, I often hear about the costs and the lost opportunities that are coming from barriers to interprovincial trade. So, as business leaders, as policymakers together, I think we have our work cut out for us. Now, these issues can't be resolved by central banks. But still, to do our job, the Bank of Canada needs to understand how these factors are affecting investment decisions. A vibrant business sector, after all, is essential to a healthy labor market and to our economic prospects. So the outlook for investment was only one of the many factors that went into our interest rate announcement yesterday. As I said, there have been some encouraging signs that investment outside the energy sector has firmed up. But let me take you through the other main points of our discussion. Well, naturally, the Governing Council spent some time talking about whether the economy was progressing as we had forecast in our April Monetary Policy Report. Now, as a reminder, we projected that the economy would expand at an annual pace of just 0.3% in the first quarter before picking up gradually to 1.3% in the second and then after that. Evidence is being accumulating that tells us that our story is on track. Now, we hope to see this confirmed in the data that will be published tomorrow by Statistics Canada. We've worked hard to understand some of the conflicting signals that we're getting from the economic data. The labor market's been strong, with solid growth in jobs and steady growth in wages. And then we've tried to square this with the strength or with the weakness that we've seen on the spending side of the economy over the last couple of quarters. Strong labor market, but weak spending. What's that gap about? Well, it turns out that the gap can be explained in large part by the behavior of companies in construction and the oil and gas sectors, which have been key drivers of the GDP slowdown. Companies in these sectors overall, over a certain period, have generally been keeping their employment levels fairly steady, but they've been reducing the number of hours that their employees are working. Now, overall, when we look at employment, this is consistent with firms believing that the economy has been going through a temporary soft patch that's perhaps been exacerbated by a brutal winter. I know you guys had it too. It's been experienced in so many places across Canada. I should point out, though, that inventories have increased sharply, and that's because we've seen continued production, strong import growth, while at the same time that demand has been pretty soft. And so, to the extent that this buildup is unplanned, it may dampen production in some sectors later this year. On top of this, there's been flooding in eastern Canada and in Manitoba, and terrible wildfires here in Alberta. It just reminds us that Mother Nature can be ruthless, and these events are causing severe hardship to many communities. They also may add some choppiness to the economic data. Now, back in April, the Governing Council said that we were going to watch developments in 3 areas: household spending, oil markets, and the global trade environment. Now, much of our latest discussion centered on these areas. It's not surprising. When it comes to household spending, we've seen strong growth in labor income, which is supporting consumption. Consumer confidence has firmed and retail sales have picked up. Of course, the housing market has been a concern in many areas of the country, including Alberta. And recent data on starts and resales make us more confident that housing markets in many places are falling more in line with what we think are fundamentals. Here in Alberta, ongoing weakness in housing can be explained by the adjustment over the past 5 years to continuing challenges in the energy sector. The Greater Vancouver area, which had been quite frothy, is still adjusting. Now, this follows changes in mortgage financing rules and past increases in interest rates, as well as the provincial and municipal measures that were aimed at discouraging speculation and foreign buyers. Weather likely affected the Toronto area in recent months. We're going to need to see more data, but that market is showing some signs of stabilizing. In terms of oil, prices have recovered from last fall's decline, Production has started to increase, profitability has started to improve, it's turned positive. But at the same time, we're well aware of the fact that curtailments and transportation constraints continue to weigh on production. These should ease over time as rail capacity expands later this year and Line 3 is completed. This will bring a welcome boost to the Canadian economy, and of course, we're going to continue to watch it closely. Now, this brings me to trade and the ongoing conflicts. There have been some positives lately. The US government has dropped its tariffs on steel and aluminum, and Canada has dropped its countermeasures. Now, this should improve the chances that the Canadian-US-Mexico agreement is ratified. Other developments, though, are discouraging. China and the United States have escalated their dispute, and Canada has been caught in the crossfire. Further, China has imposed new restrictions that are affecting Canadian farmers directly. On top of this, we see potential for more friction between the US and the European Union. Now, a big part of the bank's work leading up to the next MPR in July will be to understand the implications of these developments. Of course, we all know that trade disputes are not just a short-term concern. They also have longer-term implications for the global and Canadian economies. Now, if some of these disputes were to be resolved, that would provide a welcome boost to the Canadian and global economies. But if the disputes were to worsen and become longer lasting, the outlook would be quite different. Not only would we see weaker economic demand, but the supply side of the economy would also take a hit because companies would have to deal with disruptions in their supply chains. Obviously, this remains a major preoccupation for us. Governing Council spent some time talking as well about prices in financial markets. Since the start of the year, financial conditions have become more accommodative, as I mentioned, in many economies, and that's going to help support economic growth. But we talked also about the signals that we should take from a very flat, or in some cases inverted, yield curve. Now, these developments partly reflect a change in the tone of central banks and perhaps investor appetite for long-term fixed income assets. They nonetheless also reflect a concern about the prospects for growth that's not reflected across other asset classes. And we'll continue to be attentive to these signals. Well, let's not forget that the Banque du Canada is a central bank that targets inflation. On that front, inflation remains near 2%. There are some temporary factors that are boosting inflation. That's offsetting some modest downward pressure that's being generated by excess supply in the economy. We project that these pressures are going to dissipate over the projection horizon and inflation will stay pretty close to target. Now, for the benefit of the web audience, I'd like to deliver our key message in French and then repeat it in English. Dans l'ensemble, les données récentes ont renforcé notre point de vue que le ralentissement à la fin de 2018 et au début de 2019 était temporaire. En même temps, les risques liés au commerce international se sont accrus. Dans ce contexte, le degré de détente monétaire demeure approprié. Le Conseil de direction continuera de prendre ses décisions de politique monétaire en fonction des données. Nous porterons une attention particulière à l'évolution des dépenses des ménages, des marchés pétroliers, de l'environnement commercial international. So putting it all together, recent data have reinforced Governing Council's view that the slowdown in late 2018 and early 2019 was temporary. At the same time, global trade risks have increased. In this context, the degree of accommodation being provided by the current policy interest rate remains appropriate. In taking further policy decisions, Governing Council will remain data-dependent and especially attentive to developments in household spending, oil markets, and the global trade environment. And with that, I thank you, and I'll take your questions.
Thank you for that. That's great remarks. And I think what I really appreciated was the interconnectedness of all of this, right? And I think that's what we often forget, especially when you get into a provincial view or a city view. It's great to know the interconnectedness, because we are like, yeah, we're 80% of our goods go down to the US. It'll be fine, you know. So first question I wanted to ask is, how does the Bank of Canada stay out of that politics over policy piece? I know you're nonpartisan, we're nonpartisan, but it can get challenging.
Well, we have already our work cut out for us to understand what's going on in the Canadian economy to do our jobs. And that actually is pretty much a full-time job on the monetary policy side. It's true that the Alberta economy is integrated with the rest of Canada in ways that you really do see when you have large swings in oil prices. I think it's also interconnected in terms of sentiment across Canada. When I talk to businesses in PEI or in Newfoundland or out east or in Vancouver, they're all talking about how important it is to get investments done and the investment climate. And so success in one area can be catching in the sense that people's confidence that things can get done just kind of spreads. It's a contagion in a good way. As for politics, there's enough substantive issues that we need to tease out that we spend our time in. We are an independent central bank who has the honor of being trusted to have operational independence to do our job, target inflation. And the last thing that we would like to do is threaten that independence by wading into territory that really isn't our job.
And so globally, though, central banks have been taking a bit more of a role. And so have you got caught up in that with the G8 and the G20?
So which areas are you talking about?
So like, for example, when in Europe, like let's just say in the UK, with Brexit and right, and so then that influences what, say, potentially the U.S. bank is doing, and then does that impact what you're that piece of it? Because we do read a lot about in the investment world about what the central banks globally are doing. What is that going to mean to Canada? Can you talk a little bit about your peer group?
So yeah, by peer group, I have a hard time, commenting on the peer group in one way or another. I don't think that would be appropriate. But what I can say is that in the environment we're living in today, I don't think this is new. It's always been the case. Since I've been in the forecasting business, forecasts are going to be influenced by decisions that are made by governments and the will of the people. And sometimes those are fraught with sentiment. People really care about them. And so they're going to be political. At the same time, it's not possible for a central bank to do its job unless it does a full and honest, objective assessment of the implications of it. And so to that extent, I think that the Bank of Canada has done what we need to do to target inflation. The proof's a bit in the pudding. We've got inflation closer to 2 now, which is great. We were below that for quite a while, and because of the oil price shock and some other things. But we couldn't have done that job if we hadn't made an honest assessment of the world we live in.
Mm-hmm. And we appreciate that, because one of the things the chambers have been saying is to keep public spending in check with inflation and be fiscally responsible. So one of the questions we have here from the audience is, so Canada has been spending a lot on public sector infrastructure. Is it possible that we're spending too much, and are we too dependent on providing that as a stimulus in our economy?
So there's a lot of discussion out there, not just in Canada, but globally, about what's the role of fiscal spending. Should there be more of it? Should there be less of it? And we all know that the economics of deficits and debt rely on the conditions, a couple of things, the conditions under which you're issuing it, so how much you're paying for it relative to the growth you can expect to get from it. That's one thing. And in the current context, when you look at the debt to GDP ratio, if you're talking about the federal government, it looks pretty stable. I think the other important thing is what the spending is on. I talked a lot about productivity in Canada, the competitiveness, and you see studies out there that talk about, well, what does Canada need to improve our productivity, especially in the new age of digitalization and other things. And infrastructure of different sorts is just at the core. That includes transportation to get products to market, but it also includes other types of infrastructure that may be more digital in nature. And so I think what the spending is on is also extremely important.
I liked your comments about the fact that we're behind in some of our innovation and R&D, and that, I mean, in order to leapfrog that, does it mean you take from somewhere else and go that way? I think you mean in balance, but I just don't want anyone to walk away thinking you're suggesting we spend all our money on that, on the
That
research
wasn't my
innovation.
suggestion at all. I was just trying to diagnose what was going on with investment in Canada. Part of that comes from the data, and part of that comes from the conversations that we have with business leaders who are actually making the decisions and putting their capital and the capital of their shareholders at risk.
Our next question is a little bit about, so the Bank of Canada having recently started to talk and consider and talk about climate change. Could you comment a bit more about that?
Sure. So climate change is one of those topics that covers so many aspects. And when we thought about what was our role and what was our engagement, what would be an appropriate engagement in this area given our mandate, it was pretty clear to me and my colleagues that our focus and where we could add value would be on the financial side. So what I mean by that is what financial risks would come from physical risks, and what kind of financial risks and opportunities could come from transition risks to a lower carbon environment. We know that, just as an example, portfolio managers around the world are thinking about how to integrate climate change into their investment policies. That's just one example. And so studying that is a difficult thing to do. That's why we joined there's an international network of central banks and supervisors that's run out of Paris, and we just joined that. Part of that initiative isn't only just analysis, but it's also trying to get the right data and information, have the right terminology, so we're actually talking about the same thing. I think the final area is our own activities. And so that work is work that many institutions are doing, central banks, pension funds, and others, to look at their own investment policies, their own reporting, and the transparency of their reporting, as well as the efficiencies of their operations. So that's kind of an internal leg to the work that we're doing. But what I'd like to emphasize is that this is a longer-term project that we have, and our intent is to keep it squarely focused on the financial stability implications.
Okay. So I had started with politics outside of policy. So this question I'm going to frame in the context of, so this is a rules and recommendation from the Bank of Canada on equalization payments. It's from the audience.
So I'm sure that the audience member understands the importance of the question. That's why they asked it. But they can also understand that that's not a question for me to answer.
Yeah, no, I appreciate that. So what is the Bank of Canada's position on regional-based stress test policies? So the City Council here in Calgary is particularly in favor of reviving our construction and real estate industry. Can you comment on regional-based stress testing?
So the stress tests that are applied to mortgages when you try to get a mortgage. Yeah, and so we've spent a lot of time looking at the effects of the B20 and other parts of the stress testing that have been put in place to reinforce mortgage underwriting and the sustainability of the mortgages that are actually taken on. And when those policies were put in place, the intent was really a financial stability intent. It wasn't meant to target any particular market. Not surprisingly, what we see is that the biggest effects are going to be in markets where the prices were the highest and therefore relative to income, so affordability was the least advantageous, so that the mortgages that people were needing to take on were higher. And just to be specific, what really caught our eye was the rise in the loan-to-income ratios that were over 450%. What we've seen on the implications is that mortgages and the housing market is being affected across the country because of this, because people across the country are constrained by the stress test. The people that have been affected the most are in Toronto and the greater Vancouver area, and that's why, along with interest rates and some very local tax measures and other measures, we've seen a more marked slowdown. I think that these stress tests are serving their purpose. It doesn't mean I don't think they're not difficult for people, but the biggest issue with respect to being able to get a mortgage is not the stress test, it's the price of the house. When you look at debt service ratios increasing, it's not the interest rate that's been driving that as so much as the house price. And so affordability is an issue that is outside the remit of monetary policy, and it certainly isn't the objective of the stress tests. And when we think about the difficulty today of people not being able to get a house, it is difficult and it's disappointing to have to spend more time saving. At the same time, we also know crisis was a great example. When there's a big run-up in prices and it falls, the people that have the hardest time are the ones that are highly levered and lose their jobs. And so there's a balance to be struck there, and B20 and the other regulations are taking a longer view.
So we heard from, and you mentioned as well, like the Conference Board of Canada and, potential slight recession forecasted. I appreciate you started with that closed with that fact that 2018 was, temporary in the fall there, and then now we're in growth, and we do see alignment with your forecast, and hopefully July lines up with that. Can you comment a little bit on, where the factors that the Conference Board of Canada speaking to, housing and curtailment and transportation, how that links in?
Yeah, so I don't know the details of the Conference Board forecast. I wasn't looking under the hood when they were doing it, but I did read the same article that you did, and we don't do, we look at every region. I talked about what the implications were for oil and gas. We don't publish regional forecasts because our job is really inflation, and that requires a macro view, as I said earlier. That being said, the factors that are important, there are many factors that are important this year for Alberta. I can say what we've assumed in our forecast that's pretty important to the stabilization in the investment after the 20% fall. And that's related to an assumption that the rail capacity is going to expand at the pace that had been announced and agreed to. Doesn't really matter how it expands, but just the fact that it expands. We've also got Line 3, an assumption about Line 3 coming together sometime mid-2020, so later. That has some effect later on. We don't have any assumptions about Trans Mountain or the others because they would be outside our forecast horizon anyway. Those are pretty key ingredients. I would also say that along with that for Alberta is the stabilization of the housing market. How lower, I don't know whether people realize who's been renewing, but mortgage rates are quite a bit lower than they were at the beginning of the year. I think about 60 basis points lower. I haven't looked at it in the last couple of days, but they're a bit lower. And so that combined with just more positive financing conditions should also add some lift.
Perfect. Thanks for that. And I really, again, we're closing now, so I don't know if there's any final questions. No, but yeah, so thank you for coming and thank you for your comments. I really do appreciate the connectedness in the macro view because it can get lost. And what we're trying to say here from Alberta is that we are investment worthy and there is a lot of value to unlock in Alberta. and it is an international marketplace, and the more we can remind ourselves of that and that how policies impact the global supply chain. You had mentioned, there's excess supply impacting inflation, stuff like that. For us to know that as we plan out into this growth, because we really do have a sentiment of growth here. So thank you, and I appreciate your comments.
Yeah, thank you.
Thank you.